Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to our podcast. I'm hoping that all of you are doing well and staying safe. This is episode 107, 107th of your Tax-Free Life podcast. I'm excited to be here with you each and every week. And obviously, we're going through a tremendous amount of turmoil due to the COVID-19. So, many of us are staying home and keeping our social distancing and so forth. But I'm very busy. I'm very busy answering many of your questions, whether you attend one of my webinars or one of my podcasts, or you watch any of my videos on YouTube and so forth. I keep getting lots of questions regarding all kinds of issues, tax planning, retirement planning, retirement contributions and so forth. So and also different products and services that may be suitable. I'm getting a lot of questions on annuities, which is something very critical that I'm going to be discussing today. And because of the fact that I've been getting a lot of questions regarding annuities and safety and obviously rates of returns in retirement and so forth, this past Saturday I went ahead and did a webinar called 5 Reasons Why You Need Annuities in Retirement. So what I'd like to do today, now I know that some of you were able to log in and you attended that 1-hour webinar, which was full of information. If any of you wants to see the actual webinar, feel free to reach out to me and I'll send you the link to YouTube so you can see it. You can also go to YouTube and search for Bert Salazar, and then you'll be able to see my YouTube channel and be able to take a look at all the videos that I have there available for you. But I went ahead and did this webinar again called 5 Reasons Why You Need Annuities in Retirement, because again, I'm getting a lot of questions. So I want to kind of walk you through some of the topics that I discussed during the webinar. Now, I'm not going to go through the entire detail because I don't have an hour to do this podcast, but I do want to give you the highlights, which I think are going to be very, very important for all of you along those lines. So as you all know, obviously, my goal and that of my firm is changing the financial world one client at a time. So if I can make a difference in your life, in your financial life, and the life of your family, then I have done my job. And I do that on a one-on-one basis, and that's something that I'm very proud of, because my firm specializes in not being all things to all people, but being some things to some people. Now, during the webinar, I talked a little bit about the retirement kill zone. And the retirement kill zone, whether you think there's one or not, well, there is one. And for me, the retirement kill zone is that area in which, let's say that you're going to retire at age 65. So the kill zone for you would be the 5 years preceding your retirement at age 65. And then the first 5 years post-retirement. So if your target goal is age 65, the financial decisions that you make between the ages of 60 and 65, and then later from 65 to 70, are going to be critical in whether you're going to have a successful retirement or not. Because what I have a tendency to see is that many of the clients that I engage for the first time have made financial mistakes either right before they retire or immediately after retirement. So if you take a look at that 10-year window, which is the 5 years preceding and the 5 years post-retirement, those are the most critical years in your retirement life. If you do it the right way, you're not going to run out of money before you run out of life. If you make a mistake, it could be detrimental to you, your family, your business, and your retirement. So obviously it's important to pay attention to that. Now, normally On a one-on-one basis, I go into a lot more details, but again, I just wanted to share with you today the fact that you have to be careful about every single decision that you make during your retirement kill zone. And the best way to do that is to stop looking at your financial decisions through a microscope and look at them through a telescope. Now, this COVID-19 status is, it's a big issue for us. I mean, some of us have been home for 30 straight days and not being able to work. I have no idea how much longer this is going to go. I guess it's going to be on a state by state or municipality by municipality basis as the economy starts to open up at some point in time in the future. But we're living a new world, and this is a new world that we have to be able to do. As I did in the Marine Corps many years ago, you're going to have to be able to adapt. You're going to have to be able to adjust, and you're going to have to be able to improvise. So the challenge is that in retirement, if you run out of money before you run out of life, then COVID-19 status is going to be permanent when you run out of money for the rest of your life. Because most of us are sitting home, we're not spending a lot of money now. We're not making any money anyways, but we're not spending as much money as if we could go out and spend time in the restaurants and the bars and the communities, going to the movies and so forth. But if you run out of money before you run out of life, you're going to find that COVID-19 is going to be permanent for each and every one of you, because you're not going to be able to do much. Now, you may go to McDonald's or Burger King once a week and get a hamburger or a Whopper of your choice, or go to the movie once a week, but that's about it. That's definitely not the kind of retirement that, number one, I would want for myself, and number two, I would want for any of you along those lines. Now, the other thing I can tell you from the webinar that I covered on Saturday on the 5 reasons why you need annuities in retirement is that saving for retirement is the easy part. If you're committed to savings, you're going to put money away, whether you're going to do it in a mutual fund or you're going to do it in a 401k or an IRA, or whether you're going to invest in real estate. That's the easy part. You're going to invest, you're going to do it on a continuous basis, you're going to be hoping to get the highest possible rate of return on your investments. So that way, when you get to the summit of retirement, which would be that year in which you're going to be pulling the trigger and retiring, then obviously you're going to hope to have enough money set aside so you can make it through your retirement years. And that's the easy part. Now, some of you do a good job at that. Others do it better. Some others may not do as well. But at the end of the day, you're going to get there sooner or later, regardless of how good of a job or how bad of a job you do. But that's the easy part. Now, once you get to the top of the mountain, or your retirement mountain, and you get to the summit, and you're going to start coming down, that's where the rules of engagement are totally going to change. And that is the number one reason. And now that becomes the most difficult part of your journey, because reaching retirement is only half the way. So it's just like in a football game. Nobody cares what the score is at halftime. There's only one score that matters, and that's the one at the end of the game. So for you, in your retirement life, the only score that matters is once you go through your retirement life and you pass away, and you want to be able to look back, or your family be able to look back and see, how well was your retirement, and did you accomplish all the goals and objectives that you had in mind, or what was the outcome that was more prevalent than that. So the one thing that I can tell you from my 30 years experience is that for 99.9% of the clients that I engage, without annuities, most retirement plans are going to fail. And the one reason for that is you got to think of an annuity as a guaranteed paycheck. Is guaranteed income for life. Now, if you do a deep dive, which we're not going to do today, you're going to realize that if you have the ability to have a guaranteed paycheck for the rest of your life is going to be a lot better than if you didn't have a guaranteed paycheck, because otherwise you would have to be trying to figure out how to generate the next paycheck and the next one and the one after that and so on. Now, there are 5 reasons why you need annuities in retirement, and I'm going to walk you through all the 5 right now. The first one is longevity risk. See, none of us know when our day is going to come that we're going to die. So the biggest challenge, if you don't know the day you're going to die from a retirement and a longevity standpoint, is that once you hit your retirement age and you have all this money saved and set aside for retirement, you're going to have to be very careful as to how you manage your money. Now, why? Well, simply because if you pull too much money out of your retirement accounts, then you will run out of money before you run out of life, and you may have no choice but to drive over to Walmart and go to their HR or hiring department and ask for applications so you can become a Walmart greeter at a point in time in your life that you really didn't want to do that. But because you overspent, then obviously you ran out of money before you ran out of life. Now, the other thing that can happen, and this may happen to many of you, is you're going to underspend. So that means you're going to spend less and you're going to do less. So that means that your standard of living in retirement is going to be a lot less and a lot worse than what you had intended, because you had all of these goals and objectives in mind. But because of the fact that you don't know how long you're going to live, then therefore you're going to have to watch your money very carefully, especially since most Americans are now living almost 3 decades in retirement. So you're going to have to figure out a lot of things from a longevity standpoint, and how do you fund that longevity planning. So you're either going to spend a lot of money and run out of money before you run out of life, or you're going to spend very little money, and then your retirement life is not going to look anywhere near what you intended it to. So therefore, longevity risk is one of the biggest challenges and reasons why you need annuities in retirement. The second one is withdrawal rate risk. So the withdrawal rate risk is the one that you're taking too much and you run out of money in your slow-go years, and you take too little and you won't have an enjoyment. So it goes hand in hand with longevity, and we already talked about that. So if you take too much on an annual basis from your retirement accounts, again, you run the risk of running out of money before you run out of life. And if you take too little, then what kind of retirement are you going to have? So longevity and withdrawal rate risk are incrementally important, because longevity, you don't know when you're going to die, and then the withdrawal rate risk is the one that can put you in a really bad position from a retirement perspective. Number 3 would be the sequencing of returns risk, and this is a big one, because what happens is, when you're putting money away for retirement, you're thinking about the accumulation rate, and it's the amount of money that you put in, the kind of rate of return you're trying to get, and then obviously how much contributions are you making from one year to the next. Now, if the market goes down, then obviously there's a high probability you may recover in the future, because you don't need those assets, because you're still fully employed, your family's still fully employed, and you're just putting money. So if you lose money during those years, many a times you have a paper loss. The minute you hit retirement, and all of a sudden you go from accumulation to distribution, the rules of engagement totally change, because you can no longer concern yourself or worry about the average rate of return. You have to worry about the actual rate of return, which is the one that you're going to be living in when you're in retirement. Because if your account values go down in a given year, but you also need to take money out of those accounts that are depreciating in value because you have to maintain your standard of living, your actual losses may be much higher than they would have been otherwise, because now you have no choice but to dip into those accounts and take money out whether you need to or not, because you're used to eating 3 times a day. You may want to cut it to twice a day, but that's not going to last too long. So we've talked about longevity risk, we've talked about withdrawal rate risk, and we have talked a little bit about the sequencing of return. Also bear in mind that if you retire at a given year or at a given period where the returns on your investments are down for maybe 1, 2, or 3 years in a row, the probability that you're going to run out of money before you run out of life is going to be anywhere between 11 and 13 years more than if you retire in years where the market goes up for 2 to 3 years straight. So you have to, and nobody knows. You don't know if you're going to retire at age 65 or 60 or 70, what the market is going to be doing at that point in time. So how do you prepare for that? So if you retire in a good market, then your retirement is going to last a lot longer than if you retire in a bad market. So, and how do you capitalize on that? It's almost an impossibility to predict a financial outcome, especially in the future. Now, so we've talked about longevity risk, withdrawal rate risk, sequencing of return risk. Now let's talk a little bit about inflation risk. And for me, inflation is the silent killer of retirement. And the reason for that is that it's all around us. Now we see it now, especially if you go to the grocery store, you definitely see the cost of inflation. Or if you go put gas at a gas station, you see it. Now notice that because of COVID-19 and the fact that most of us are not driving that much, it's a supply and demand. So you've seen in the price of oil, because of the oil wars in the Middle East and so forth, have actually been lower than for the last 5 to 7 years. So that's a good thing. But what good is it to you if you can't leave your home and you can't go out? But let me put it to you in a way that I think you'll be able to understand a little bit more. Now, if you take a 4% inflation rate, by the way, and for those of you that think that inflation is at 3%, you better think again, because inflation is not tax deductible. So whatever your inflation rate is, your personal inflation rate, to that you have to add your tax bracket. So therefore, for some of you, inflation may be at 4%. Or maybe 3.75%, or 4.5%, or 5%, depending on your tax bracket. So always remember, inflation is not tax deductible. So at a 4% inflation rate, it actually cuts your purchasing power by 50% in 20 years. So therefore, if inflation is at 4%, you're going to lose 50% of the purchasing power that you have in today's dollars over a 20-year period. So you're going to have to find ways to make that up and take more risk in order to mitigate the fact that you're not going to be able to purchase the same amount of goods and services 20 years from now that you were doing today. By the same token, the same 4% inflation rate over a 30-year period, not a 20-year period, will actually destroy your purchasing power by 2/3, by 66%. So paying attention to inflation is a critical one. And then last but not least, the last reason why each and every one of you should be owning annuities in your retirement accounts is deflation risk. If inflation is bad, deflation is just as bad as well. And deflation is just a slowed economy. When economic factors slow down and when the economy slows down, then that means that in many different ways, there's not much you can do. Why buy something today if you can buy it cheaper in 6 months? So all of a sudden you start to hoard and you start hoarding your money, and the economy does the same thing, and the industrialized companies will do the same, and the major companies will do the same. So all of a sudden the economy slows down to either a recession or could be even a depression. And that deflation risk creates a major havoc for all of us when we're in retirement. So going back and addressing once again the 5 reasons why you need annuities in retirement: longevity, and the fact that you have no idea how long you're going to live; withdrawal rate risk, not knowing if you're actually taking too much or too little; sequencing or return risk, which is not something that you have any control over because you have no idea what the market is going to do at a given point that you're going to be retiring; inflation, and how do you protect that, obviously; And then last but not least, the deflation rate risk. So those are things that are very prevalent, and this is why annuities are so important in an overall retirement portfolio. Now, one of the questions I get often is, Bert, how do annuities manage retirement risk? And one of the things that I can tell you is that, studies have been done as to when Americans usually spend the most amount of money, and it's usually on Saturdays. And when you retire, every day becomes a Saturday. Every day becomes a Saturday night. So most of us, when we retire, we want to travel, we want to do things that we had not had the time to do before because we were too busy working and trying to make money and save money for retirement. So now we want to catch up. So the problem is that when you retire, every day is Saturday. So annuities can help you manage that overspending risk that most of us are going to face early in our retirement years. Now, this is a fact, and this is not fallacy. Only an insurance company can optimize your income in retirement. You cannot do it yourself. I don't care how much you try. It's a mathematical, scientific, and economic fact. There is no way that you can do it yourself. Only an insurance company has the ability to optimize your retirement income in retirement, not only for you, but also for retirement. Also consider that annuities, for the most part, are a retirement risk management tool for retirees. And the reason for that is that, most pensions have disappeared. The 401k shifted the retirement liability from the company that used to offer the pension now to the employee and to the consumer. Now, the companies, all they're doing now is they're giving you a match on your 401k, and then obviously you got to worry about, are you putting enough money away? What kind of rate of return are you getting? Are you suffering losses in your retirement? Have you done the proper calculations to determine what you're going to need at retirement? What are going to be your fixed expenses, your variable expenses? Remember, I said that saving for retirement was very easy. Once you get to retirement, it's a different ballgame, and it becomes quite complex for the vast majority of Americans that I deal with. The other thing that we need to deal with is taxation. And taxation is another silent killer that you get to see every single year. And the problem with taxation is that they're going to be a lot higher in the future than they are today. For those of you that may not know the Tax Cuts and Jobs Act will sunset December 31st, 2025. So when we all wake up January 1 of 2026, we're going to find ourselves in a higher tax rate than we are today. The standard deductions will be lower and the tax brackets would be higher. But because of all the stuff and all the debt that we have in our country and so forth, and what we're going through and the amount of money that we're borrowing and creating out of thin air in order to get this economy back running after going through this major pandemic and financial and medical disaster that we're going through, then the taxes are going to have to double or we're going to go bankrupt. Well, if taxes are to double, then your 401k, that $1 million of retirement assets that you thought, you had maybe $750,000 available to you and the other $250,000 to the IRS because you had not paid taxes on those assets, now may only be $500,000 for you and $500,000 in taxes to the IRS. How much do you think your retirement life is going to change if your taxes were to double, at least go up by 25-30% in the future? It's going to be a lot worse because at the end of the day, it's all about the net cash flow. By the way, many times people ask me, Bert, can you really talk a little bit about what $1 trillion is? Because now you hear all these politicians talking about $1 trillion like it's going out of style, and nobody truly knows what $1 trillion is. I know. And what I'll do is I'll give you a quick analogy that I'll think you'll understand very easily. And this is the analogy of, let's compare $1 trillion to time, to the value of time. Whether it's a second, whether it's a minute, whether it's an hour, whether it's a day or a year, or whatever it may be. So let me put it to you this way. if we're going to compare $1 trillion to time, $1 would equal 1 second. $1 million would equal 11 and a half days. $1 billion would equal 32 years. And $1 trillion would equal 32,000 years. You see the difference between 32,000 years and 1 second, or 11 and a half days, or 32 years? $1 trillion is an enormous amount of money. And yet, the unfunded liabilities for the United States of America is sitting at $126 trillion and counting every day. Now, some people try to complicate annuities, and I try to keep it simple. Now, the internal works of an annuity are complex, and they're actuarially based. But at the end of the day, if you own a public, a private, or Social Security benefits, or you have a public and private pension plus Social Security benefits, then basically you have an annuity. A public pension that you receive if you're a public employee when you retire is an annuity. If you have a private pension and you're lucky enough to get one from a private company that you work for, that's an annuity. If you're getting your monthly check from Social Security, that's an annuity. See, an annuity is nothing more and nothing less than guaranteed paychecks for the rest of your life. Now, I deal with a lot of retirees because of the market that I'm in. I'm also deal with public safety and public employees throughout the United States. I have a lot of clients in that market. And I can tell you this, I have never had a retiree tell me that they hate their guaranteed paychecks. Now, for those of you that may have a pension or are going to be eligible for a pension at some point in time in the future, or Social Security benefits, how many of you would give up your pension and Social Security benefits today? I'll wait for an answer. Nope, none of you will. So therefore, you do have the ability to create your own pension benefits by using annuities for a portion of your assets on your side of the ledger. Another question I get often asked is, Bert, how many types of annuities are there? And there are basically two types. You have immediate annuities, or SPIAs, single premium immediate annuities. And basically those annuities are the ones that you start getting guaranteed payments that will actually commence within 30 days. Now, you can delay them a little bit more, maybe even up to a year, but most of the clients that I engage when we move forward with an immediate annuity is because they want guaranteed payments coming into them almost immediately, or at least within the first 30 days. So therefore, you're getting a guaranteed paycheck for life and or any other combination that you may choose depending on your personal circumstances. The second type of annuities are deferred annuities. So you have the immediate annuities where everything starts right away. Deferred annuities, as the name says, you're deferring the start date for that guaranteed paycheck coming into you. And that could be anywhere from 1 year to 20 years, depending on how long you want to wait. And then again, you're getting guaranteed paycheck for life and or any other type of combination. Now, within the deferred annuity market, there are a number of different products. Some would be a fixed annuity, others would be index annuities, others would be variable annuities. I don't have the time to go into details. Sometimes we use a combination of fixed and index annuities depending on the needs, goals, and objectives of our clients, so it really depends on you individually. And then another question I get asked once I'm answering the type of annuities that are available is, Bert, what are the different types of payouts that you can get? And the way I can answer that question is to tell you that it's just like going to Baskin Robbins to buy some ice cream. When you get there, actually their logo has the number 3 and the 1, because there are 31 different flavors. So the same thing happens with choosing your annuity payouts. And there are many different ways depending on your goals and objectives. So you can buy a single life annuity that will pay you income till the day you die. and then that income will stop at time of death. You can also buy a joint life annuity with your spouse if you happen to be married, so that way it'll pay an income for your life, and then upon your death it will continue to pay an income to your surviving spouse for his or her life. You can also do a joint life with your kids. You can do a joint life with your grandchildren. You can do a life payout with let's say a 10-year, a 20-year period certain. So if you do a 20-year period certain, that means that you will get a payout for the rest of your life. But if you only live, let's say, 5 years out of the payout and you have a 20-year period certain, then your beneficiaries will receive payments for an additional 15 years. You can also do life with a guaranteed death benefit. You can do life with a cash refund at the end of the period. So there's a lot of stuff that you can do with annuities, but then again, each and every one of you is a different financial world, so the decisions would be totally different. Now, one of the things that I discuss with many of my clients that most Americans have no clue about, and I would argue that the majority of you on this podcast truly do not understand, is that there is a hidden value in annuity payouts. And this is a reason why annuity payouts always win when you try to compare it to any other type of payout. Some clients may say, well, what if I invest in CDs and use the payout? Well, we all know where CDs and the rates are today. They're very, very low, so that's not going to be worth it. Now, you can buy into stocks and say, well, I'm going to use stocks. I'm going to sell them at the end of every year. And then obviously that's going to be my payout. Well, now you have a variable. You have no idea what the stock market is going to do from one year to the next. I mean, take a look at, when your 401k becomes a 201k. So you're going to have a retirement life that is not going to be guaranteed, and you're always going to be in fear of not having enough payouts on an annual basis. Some of you are a little bit smarter, and you may say, you know what, Bert, I'm going to invest my money when I retire in dividend paying stocks, and that's fine. You can do that, or mutual funds for those things as well. The problem is that none of those are going to produce any type of guaranteed payouts. And the thing that makes annuity payouts so critically important, at least to be part of your retirement portfolio, is that the payout from an immediate annuity includes principal, includes interest, and probably the 10th wonder of the world, which is something known as mortality credits. By the way, the vast majority of your financial advisors out there and the ones that are dealing with you have no clue what mortality credits are. Let me see if I can explain it to you, because it's a little bit complex, but I'll try to make it simple. When you look at mortality credits, by the way, if you invest in a dividend-paying stocks, when the company that you invested your money with declares their stock dividend for the year, it doesn't matter whether you're 30 years old, 50 years old, 70 years old, or 80 years old, the payout is going to be the same based on the declared rate that that company did for that year. That's it. When it comes to annuities, depending on your age, your mortality credits will actually increase. And the reason for that is, remember when I talked a little bit about the number one reason why you need annuities in your retirement? Remember I talked about longevity? And the biggest risk that you have is that if you're 65 years old, you don't know how long you're going to live. Well, insurance companies do. Insurance companies do in the sense that when they're pricing their mortality credits and they're pricing their products, whether it's life insurance or annuity from a business perspective, the way that they do it actuarially is they look at an average of 10 million lives. So if you're 65 years old, insurance companies have been doing this for hundreds of years, by the way, so they're experts at managing risk. They look at the 10 million lives of 10 million age 65 healthy Americans living today. And then they're going to say, okay, what is the probability that this group of 10 million people is going to die, and when are they going to die from one year to the next? So let's say that once they do their calculations, they determine that on healthy 65-year-olds, 10 million of them, their mortality is going to be age 85. By the way, the definition of mortality simply means that 50% of that $10 million group is going to die before they reach the age of 85. And then the remaining 50% or the remaining 5 million are going to die north of age 85. So the question for you is, which side of the two groups are you going to fall into? The ones that are going to die before age 85 or the ones that are going to die past the age of 85? Now, the insurance company may not know whether you personally are going to live to age 85 or not, or past age 85, but they know that of 10 million people, they know that 50% of them are going to die sooner, and 50% are going to die later. So they're able to price their mortality credits accordingly. So the older you get and the older you are, the higher percentage of mortality credits that you get added on to that guaranteed monthly paycheck that you're going to get, or annual paycheck, depending on how you choose it. And that is why there's no other investment known to mankind that will give you a guaranteed paycheck for the rest of your life that will include principal, interest, and mortality credits that actually enhance that payout from 1 month to the next, or from 1 year to the next. So I'm hoping that that'll give you some flavor. Obviously, for those of you that may want to pick my brains about that, feel free to call me. I'll give you my information at the end. Another question that I get from my clients when we're talking about longevity planning is, Bert, what are the probabilities of outliving my retirement assets? And my answer to that is not only for the clients that I talk to. Now, once we do proper planning, then we're able to address that issue. But for the vast majority of you, you're all going to run out of money before you run out of life. Because let me give you some statistics, and these I just pulled out of the government website just about 30 days ago. 50% of all 65-year-old males today are going to live to age 87. So if you're a male and you're 65 years of age today and you're fairly healthy, there's a very high probability you're going to live to age 87. Now, 50% of all 65-year-old females today are going to live to age 89. Now, women have a tendency to live longer than men. So if you're both 65 years of age, men are going to live traditionally to age 87, and women are going to live to age 89. Now, if you're a married couple, husband and wife, there's a 50% chance that both spouses are going to live to age 82. And there's a 50% chance that one spouse is going to be alive at age 93. So now when you're talking about retirement distribution planning, now you got to start thinking 30 years, 65 to 95, just in case. You know, I have clients that are in their mid to late 90s. My oldest client just turned 102, I think it was in November or December of last year. So running out of money before you run out of life is going to be a big issue for all of us to deal with. And also think of it this way, for those of you thinking about bonds and treasuries, well, the 10-year treasuries are less than 1%. So that's going to have a negative impact on your fixed income and from savings and CDs that many of you in retirement are going to have to start thinking about. So again, the probabilities are extremely high unless you have annuities as part of your retirement distribution planning. Now, Ben Bernanke, who was the head of the Federal Reserve years ago, the vast majority of his retirement income was in annuities and pensions. And this is someone that understood economic challenges and risks better than anybody else. So now the question that I get often asked is, well, you know, after knowing all these things about annuities and the power that they bring to the table, which annuity do I choose? And which annuity payout do you choose? And then, you know, before I can answer that, I have to ask you two questions. Question number one is, what do you need your money to do while you're alive? And question number two, what do you want your money to do for you once you're gone? So if you're able to answer those two questions, then it makes it a lot easier for me to put together a portfolio of annuities that is going to be suitable not only for what you want your money to do for you today, but what you want your money to do for you at some point in time in the future. And then obviously, the types of payouts are going to change as well. Do you want level payouts? Do you want an inflation protected payout? Do you want a combination straddle payout, which is a combination of both? The other thing is, how much money do you want to, or what kind of expenses and liabilities do you want to protect? If some of my clients are not as conservative, but they want to protect all of their fixed expenses. So they want to know that when they wake up at the very beginning of every month, that all of their fixed expenses are covered, because they just had a deposit on their bank account from an annuity company, paying them enough money for them to cover their expenses for that month and that year and for the rest of their lives. Now, some other clients that I have are more conservative, and not only do they want their fixed expenses to be covered, but also their variable expenses as well. And then we can do a fudge factor there where we can include some inflation hedging as well. And that's where deferred income annuities come into play. So, it really depends on what you want your money to do for you. What I can tell you is the following, is that when you have guaranteed paychecks and guaranteed paychecks, as Tom Hegna talks about, and all the seminars that he does, and the books that he writes, when you have guaranteed paychecks and guaranteed paychecks, it actually gives you more flexibility in what to do with the rest of your money. Because if you don't have to worry that much about making ends meet and meeting your fixed and variable expenses, then you can even become more aggressive with your other monies that you have available to try to enhance the rate of return on your investments. Or perhaps you would invest in real estate without having to worry about, what if something happens in the real estate market and all of a sudden, my money is reduced by 20-30%. Well, you don't have to worry about it because you have guaranteed paychecks and guaranteed paychecks. Another thing that I do for many of my clients is that usually you're going to have, if you have a family, husband and wife, you're always going to have one of them that is going to be more financially savvy than the other. And I have a number of wealthy clients in my portfolio that buy a lot of annuities because obviously they are the ones that are the financial savvy in the family, but they don't want to leave a lot of mess when they die for their surviving spouses to figure out whether it's a male or a female surviving spouse. So they buy guaranteed annuities that upon their death, that annuity income will continue to their surviving spouse for the rest of their lives. So it's actually alleviating that pressure on someone that may not be as economically savvy as the person that just passed away, to be able to mitigate and deal, with the risks of losses in retirement a lot better than if they wouldn't have anything else. My final thoughts, so I can finish this podcast for all of you, is that number one, guaranteed income in retirement and guaranteed paychecks in retirement is irreplaceable. You cannot replace a guarantee. That I can assure you. Nothing comes close to a guaranteed paycheck. Number two, tax planning can actually assist you and your family in maximizing your retirement net income while minimizing your tax liabilities. Think of all the stuff that I've said about the liabilities in this country and where taxes are going to be in the future. So if you can now reduce your tax liabilities significantly, and by the same token provide guaranteed paychecks not only for your life, if you're single, but for your life and your surviving spouse's life, or children or grandchildren, if you have a family, then obviously that becomes even more paramount than anything else that you could ever do. For those of you that already own annuities, if you haven't done an audit on your annuities, please reach out to me, because we specialize in life insurance and annuity audits, because there are a lot of products available in the marketplace nowadays that were not available before. So perhaps an annuity audit is apropos to make certain that you have the right annuity in the right place and for the right reasons. And then last but not least, it's important that all of you engage in creating a tactical retirement blueprint, which is something that I do for my clients, because a tactical retirement blueprint will actually save you from yourself. Most important is going to address the fatal for retirement, the risk of dying too soon, living too long, living with a disability, and living with eroding factors like taxes, inflation, stock market volatility, and so forth. So at the end of the day, you need to understand that annuities play a tremendous role. And for those of you that don't have any in your portfolio, I think it's important that you start to look at that very closely. If you don't have anyone that you can visit with, feel free to call me. You can always reach out to me at area code 786-766-1042. Otherwise, you can send me an email at either Bert, B-E-R-T, at gablestaxgroup.com, or to make it easier for you, you can send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for each and every one of you, every single week, and for each and every one of your families, is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. Thanks very much for giving me a few minutes of your time today. Stay safe, stay healthy, give my very best to your family, and I'll talk to you again next week. Take care. Bye-bye.